If you're looking at the headlines today, January 15, 2026, you might feel like you need some whiplash insurance.
Right.
The news cycle is it's absolutely overloaded. We're seeing reports on record-breaking profits for Wall Street, but then also these crucial shifts from global central banks.
And a political firestorm aimed, squarely at the head of the Federal Reserve. It's an intense mix.
It really is.
But that's exactly why we're here. Our mission today is to try and distill this massive flow of information. We've got earnings from Goldman Sachs and Wells Fargo, new monetary policy moves, and some huge U.S. policy shifts on everything from AI chips to credit card rates.
So we've synthesized all of it. Global market data, the key earnings reports, the Fed's latest beige book, and all the crucial geopolitical updates. We're going to walk you through it.
And the core question we're really trying to tackle today is about divergence. We are seeing this powerful, stark split.
A split between what?
Well, why is the investment banking arm of Wall Street just thriving, reporting massive backlogs and profits, while at the same time the consumer credit segment is flashing some deep warning signs? Unpacking that split, I think, gives us a really clear view of the global economy as we head into 2026.
Okay, so let's unpack that. Let's start with the financial giants, specifically the deal makers. Goldman Sachs. They reported some seriously compelling numbers.
Oh, yeah. They far surpassed market expectations.
For the full year 2025, they delivered what, $51.32 in earnings per share?
Which is up significantly from $40.54 the year before, a huge jump. And Q4 was strong, too, at over $14 EPS.
And those numbers, they weren't just good on their own, right? They were a clear indicator of momentum.
At the highest level, yes, but you have to look inside into the engine room. That tremendous performance wasn't spread evenly at all.
Right.
The massive gains came overwhelmingly from one place, global banking and markets, or GDM. That's their core Wall Street advisory and trading business.
So the deal makers and the traders, what did their results look like?
GBM net revenues were up 18% for the full year 2025. That's over $41 billion. But the real story here is investment banking fees, which saw a 21% jump year over year.
And that's things like advisory, so M&A volume?
Exactly. Mergers and acquisitions finally clicking, and also debt underwriting.
Okay, hold on. For the listener who hears debt underwriting, can you just quickly clarify why that specific area is so lucrative for a firm like Goldman right now?
Absolutely. So when a firm like Goldman acts as a debt underwriter, they're essentially helping big corporations package up loans, things like asset-backed securities or investment-grade bonds, and then sell them to investors.
Okay.
And in a world that's preparing for rate cuts, demand for these fixed-income assets is really high, and Goldman earns huge fees for structuring and executing those deals.
And this isn't a one-off thing.
No, not at all. The sources confirm Goldman's investment banking fee backlog increased significantly compared with the end of 2024. That means this profit surge is very likely to continue deep into 2026.
Okay, so that's the headline story.
Yeah.
But every great headline usually hides an expanded footnote, right?
Right.
And this incredible profit surge is masking the immense cost of Goldman's failed consumer experiment. They're officially ditching that whole ambition.
They are, including the agreement to sell the Apple Card portfolio to J.P. Morgan Chase.
And that decision was?
It was brutal on the balance sheet, but, completely necessary. They took a massive $2.26 billion markdown in net revenues in that unit, Platform Solutions.
Wow. So they just sacrificed almost half a year of revenue from that unit just to get out the door.
That was the price tag of escaping a toxic venture, exactly. And while it was mostly offset by a related reserve reduction, it left that division with negative net revenues for the quarter. It highlights the sharp division in finance right now. The deal makers are riding high, but anyone exposed to Main Street lending is really struggling.
And we saw that contrast perfectly illustrated by Wells Fargo, a classic commercial lender. Their stock dropped almost 5% after their Q4 earnings.
4.6%. They missed on revenue, but the real concern was their net interest income, or NII, guidance for 2026.
And NII is the lifeblood for a bank like that, right? The difference between what they earn on loans and pay on deposits.
It's everything. And Wells Fargo gave this really tepid 2026 guidance of about $50 billion. And that figure, it already assumes the Federal Reserve will implement 2 to 3 rate cuts this year.
So even if the Fed cuts rates to help their margins, they're still only guiding for $50 billion. That feels Very cautious.
It is cautious, and it reflects the pressure on traditional lending. We also saw Wells Fargo take a massive $612 million severance charge for a restructuring.
Wow.
They're spending hundreds of millions just to trim their workforce, to get leaner because they anticipate narrowing margins. It's a tale in two cities. Wall Street is celebrating M&A. Main Street banking is counting costs and bracing for a tough transition.
That leads us perfectly to the global interest rate environment, because those central bank decisions directly impact Wells Fargo's guidance. So let's zoom out. What's the big picture for global rates?
Well, what's fascinating here is this kind of global rate gridlock. Most major economies are nearing the end of their rate-cutting cycles, or they've paused. But the long-term borrowing costs, they're not dropping as quickly as everyone hoped.
And why is that? Why the stickiness on the long-term rates?
It comes down to something called the term premium. You can think of it as the extra fee investors demand to lend money for a really long time, like 10 or 30 years. Right now, global government debt is at historic highs, and there's just massive uncertainty about future inflation. That anxiety is keeping the term premium surprisingly high. So even if the Fed cuts short-term rates, the long end of the curve, which impacts mortgages and corporate bonds, stays elevated.
Let's run the central bank roundup then to see this in action. Here in the U.S., the Fed cut 25 basis points in December.
And that notably came with 3 dissents. So internal disagreement is high.
And they're expected to pause at the January 28 meeting, partly because the recent government shutdown distorted some of the data.
Right, and the market consensus, which is what Wells Fargo is banking on, still points to 3 rate cuts in 2026, probably starting around June.
Okay, so contrast that with the Eurozone.
The ECB held rates steady in December, and they're expected to hold steady again on February 5th. They seem to think they've done enough. They've essentially wrapped up their cutting cycle.
And then you have the complete outlier, Japan.
Japan is playing catch-up, exactly. The BOJ hiked 25 basis points in December. They're expected to hike another 25 on January 23rd. Projections suggest they might even squeeze in 2 more hikes by late 2027.
So they're finally trying to normalize policy after all these years.
They are. And then there's India on its own trajectory. The RBI cut rates in December because their inflation is nearing zero and growth is slowing. They're forecast to cut once more in 2026. It just shows that while the system is connected, policy is still fundamentally local.
So if we bring this complicated global picture back home, the Fed's Beige Book, which summarizes economic activity, it really explains why a bank like Wells Fargo was so nervous.
It absolutely does. The Beige Book noted that overall economic activity increased at a, quote, slight to modest pace. That's an improvement, but the data reveals this dangerous split in the U.S. consumer base.
This is where that bifurcation theme really hits home. What does the Beige Book say about how people are spending?
It said that higher-income consumers showed strong spending confidence, especially on things like luxury goods, travel, experiences. They're doing fine. The problem is the other half. Low to moderate-income consumers were described as, quote, increasingly price-sensitive and hesitant to spend on non-essential goods.
So the top segment is flying first class, and the bottom 50% is debating whether they can afford new tires. That is a textbook definition of a bifurcated recovery.
And it's a nightmare for a commercial lender who depends on broad consumer health.
Yeah.
And the labor market reflects this too. Employment was mostly unchanged, which sounds good, but firms told the Fed they're favoring temporary workers now.
Why is that?
It's a strategy to stay flexible in uncertain times. They're filling vacancies, but they are absolutely hesitant to commit to creating significant new permanent jobs.
And that reluctance to hire is actually backed up by that unexpectedly strong jobless claims data we saw.
That's right. Initial claims fell to 198,000, which is the second lowest reading in 2 years.
It's the low firing, low hiring environment. Companies are holding on to staff, but they aren't expanding.
Exactly. It paints a picture of stabilization, yes, but stabilization under a lot of duress. But the biggest source of uncertainty right now isn't the economic data. It's political.
And here is where the story shifts from finance to, well, political warfare. The crisis of independence at the Federal Reserve. Fed Chair Jerome Powell is now facing a criminal investigation by the Department of Justice.
Grand jury subpoenas were served last Friday. It's related to perjury allegations.
And the issue itself sounds almost bureaucratic, but the implications are huge.
They are. The allegations stem from his testimony about the Fed headquarters renovation cost overruns. The initial estimate was $1.9 billion, but by 2025, that cost had ballooned to nearly $2.5 billion.
And the Fed's explanation for that jump?
They attributed it to changes requested by the U.S. Commission of Fine Arts and massive unexpected costs, things like asbestos remediation, toxic soil removal. But the political opposition has seized on this as a pretext for a criminal probe.
And Powell is not backing down. He released a video statement making a very direct claim.
A very direct claim. He said he believes the investigation is a pretext to apply political pressure on the Fed to lower interest rates. He framed it not as an issue of finance, but as a challenge to democracy itself.
And this immediately went global. A powerful group of central bank leaders, ECB, Bank of England, Australia, Canada, they all issued a joint statement supporting him.
Which is a huge deal. You almost never see that.
So why risk intervening in a domestic U.S. political fight?
Because central bank independence is a global stability mechanism. They explicitly called it a cornerstone of price, financial, and economic stability.
So a threat to the Fed's independence is a threat to theirs.
Absolutely. If the U.S. Fed can be forced to change policy through political or criminal pressure, it sets a dangerous precedent for every major economy. Their defense of Powell is really a defense of their own standing.
And that collision between market reality and political intervention is playing out everywhere today. Let's look at the immediate policy swings hitting key markets, starting with energy.
Right. Crude oil prices, both Brent and WTI, they slumped today, dropped between 4.4 and 4.6%.
And the reason?
President Trump signaled he was dialing down threats of imminent military action against Iran. So the markets immediately priced out a big chunk of that geopolitical risk premium.
And at the same time, the administration made a major move on domestic tech manufacturing.
That's the new 25% tariff on advanced AI computing chips, specifically naming NVIDIA's H200 and AMD's MI325X.
And this isn't just a tariff for revenue, is it?
No, it's a strategic move. It's designed to boost domestic semiconductor manufacturing, since the U.S. currently only fully manufactures about 10% of the advanced chips it requires. They're making imported AI horsepower much more expensive to force investment here at home.
And then there's the policy that targets that bifurcated consumer we talked about directly.
The call for a massive one-year cap on credit card interest rates, fixing them at 10% effective January 20th.
The stated reason being to stop Americans from being ripped off by rates of 20 to 30%.
This is pure populism colliding head-on with financial reality, and the industry response was immediate and furious.
What did they say?
Bank trade groups warned that a 10% cap would be devastating for millions of families.
Wait, how could capping rates hurt consumers? That seems counterintuitive.
It completely destroys the risk-reward model for lenders. Banks set high interest rates for riskier borrowers, subprime borrowers, to offset the high probability of default. If you cap the rate at 10%, the bank just can't make a profit managing that risk anymore.
So they would just stop lending to them.
Their immediate response will be to cut credit availability to anyone deemed subprime, and these borrowers hold between 1/5 and 1/4 of all card balances. They would suddenly find themselves completely cut off from legal, regulated credit.
Which is a potentially destabilizing move for that lower income segment we just discussed.
Hugely.
Okay, let's wrap this section up with the massive geopolitical energy play in Venezuela. Following the recent political changes, the U.S. plans to have large U.S. oil companies go in and operate Venezuela's reserves.
Right. The immediate goal is tactical. Ship 30 to 50 million barrels of sanctioned Venezuelan oil to the U.S. right away.
Just to clear the backlog.
Exactly. It's about stabilizing the market and securing a new, close source of supply.
It sounds like a fantastic opportunity. I mean, Venezuela has the world's largest proven reserves. What's the catch?
The scale of the challenge. It's almost unimaginable. Venezuela's infrastructure is suffering from decades of decay, mismanagement, sanctions.
So it's not just a matter of turning the taps back on.
Not even close. Experts estimate that just to restore production to its historical level of 2 million barrels per day would take 16 years and cost a staggering $110 billion.
$110 billion over 16 years.
Yeah.
Are U.S. companies lining up for that?
They are wary. Very wary, and for good reason. Majors like Exxon and ConocoPhillips are apprehensive. They've had assets seized there before. Exxon's CEO literally called the country uninvestable right now. Only Chevron seems to be moving forward immediately.
So let's bring it all back home. What does this mountain of data really tell us about the state of the world today?
I think the synthesis is clear. The global financial ecosystem is fundamentally bifurcated. We have this prosperity thriving at the highest level, the deal makers at Goldman enjoying soaring fees, but then you have this profound fragility and pressure at the consumer and commercial base.
Reflected in Wells Fargo's struggles and the cautious consumer in the Beige Book.
Exactly. And underpinning this whole split, you have two powerful contradictory forces colliding.
Okay, what are they?
The first is just the sheer scale and expense of the massive infrastructure investment that's needed globally, whether it's for high-tech AI chips or for rebuilding broken energy systems in a place like Venezuela.
And the second force?
The increasing politicization of finance itself. From the criminal probe threatening Chair Powell to the direct policy intervention of a 10% credit card cap, we are watching market efficiency clash with political mandates in real time.
And that creates extreme volatility.
Extreme volatility.
Okay, so you now know that the price tag for restoring Venezuela's oil industry is estimated at $110 billion over 16 years. And given the simultaneous political push to cap credit card interest rates at 10%, which threatens to cut off credit for high-risk borrowers, here's a final thought for you.
If the government successfully forces those high-risk lenders out of the consumer credit market, who ends up bearing that unstable balance? Who will inherit that quarter of all U.S. credit risk if the banks can no longer make a profit on it?
That's a question for you to consider as we close out this deep dive.